Welcome to today's deep dive. Today we are exploring this really comprehensive 2026 guide from the financial platform Capitally.
Yeah, it's titled Dividend Investing for Beginners. 4 simple strategies.
Right. And the mission of our deep dive today is to, well, completely demystify the world of dividend investing for you.
Exactly. We want to show you how to generate that predictable cash flow that's, decoupled from those wild stock market swings,
Yeah, we're talking about building a portfolio that literally pays you just for holding it.
which is such a powerful concept for beginners to grasp.
It really is. Okay, let's unpack this
Yeah.
because I think most people think of stocks like buying a rare comic book.
Oh, that's a good way to put it.
Right. Like you hunt for it, you buy it, you wrap it in plastic, stick it in the dark box, and you just sort of pray that someone down the line pays you more for it than you originally did.
Yeah, that's that traditional, buy low, sell high mindset. You're banking entirely on capital appreciation.
Hoping the line goes up.
Right, hoping the line goes up. But the asset itself doesn't actually produce anything for you while it's sitting in that box. If the market crashes, the perceived value of your comic book drops, and you're just left with anxiety.
Yeah, just staring at red numbers. But what if investing was more like buying a rental property?
I love that analogy.
You own the actual asset, yes, but it also pays your rent every single quarter. You get cold, hard cash in your pocket just for holding the keys.
And that changes everything.
It really does. For a beginner, investing can feel incredibly abstract, just numbers blinking red and green on a screen.
Yeah, it doesn't feel real.
Exactly. But when a dividend actually hits your account, it makes the whole process feel real and rewarding from day one because cash actually hits your account.
It fundamentally changes your psychology as an investor. You stop feeling like a speculator and you start acting like a part owner of a business, receiving your rightful share of the profits.
Which is huge.
Because, as the Capitally Guide makes very clear right up front, a dividend is absolutely not a gift.
I'm glad you brought that up, actually, because it does feel a bit like magic to a beginner. Like, hey, free money just appeared.
Yeah, far from it. It's a distribution of profits. I mean, when a mature company earns more cash than it can reasonably reinvest, like maybe they don't need to build another factory or hire 10,000 more people,
Right.
the board of directors votes to distribute that excess cash directly to the part owners. But to ensure the right people get that cash, this whole process runs on a really strict mechanical schedule.
Okay, yeah, based around those 4 critical dates the guide mentioned.
Yes, 4 key dates.
So let's walk through those dates because I imagine if you misunderstand the plumbing here, you might buy a stock and just, never see a dime.
Precisely. You have to know the schedule. So the first date is the declaration date. This is simply the public announcement.
Okay.
The board declares the exact dividend amount they'll pay per share, and they establish the schedule for the remaining 3 dates.
That seems straightforward enough.
Yeah.
But the second date is the one Capitally puts in, like, bold, underlined text.
Oh, yeah.
The ex-dividend date.
That is your absolute cutoff line. To receive the upcoming dividend, you must buy the stock before the ex-dividend date.
Before it. Got it.
Right. If you buy the stock on the ex-dividend date or anytime after, you do not get the current payment. The previous owner, the person who sold you the shares, they get that cash.
Okay, so the ex-dividend date is basically the VIP cutoff line at a club. If you aren't inside the club before midnight, you don't get the gift bag.
That is a perfect visualization. Yes.
Okay, so what's the third date then?
The third date is the record date. This is the day the company actually reviews its corporate shareholder register to see exactly whose names are on the list inside that VIP club.
Wait, I'm a little confused by that.
Sure.
If the ex-dividend date already locked the doors to the club, why do we need a separate record date? Like, should they be the same thing?
They essentially are the same day now, but they represent 2 different mechanical processes. It comes down to how trades settle in the background of the stock market.
Oh, like the actual clearinghouses and stuff?
Exactly. We operate on what's called a T+1 settlement cycle. That means when you click buy on your brokerage app, it takes 1 full business day for the money and the shares to officially change hands.
Oh, okay.
So if the company is checking the record books on a Tuesday, the record date, you had to have bought the stock by Monday, the ex-dividend date, for your name to actually be processed and written in the ledger in time.
That clarifies the plumbing immensely. You basically just have to account for that processing delay.
Right.
And that leads to the 4th and final date, which is the payment date.
The best date.
Yeah, that's when the cash actually arrives in your brokerage account. And the Capley Guide uses a really great Apple example from early 2026 to make this real.
Let's look at that. So on January 29th, Apple declared a quarterly dividend of 26 cents per share.
Yeah.
They set the ex-dividend and record dates for February 9th and the payment date for February 12th.
So if I bought 100 shares of Apple on February 8th,
Before that cutoff, yes, you received a $26 deposit on February 12th. But if you bought on February 9th, you got nothing until the next quarter. And, what's fascinating here is what mechanically happens to the stock price on the morning of that ex-dividend date.
okay, I was hoping we would get into this because the guide mentions it, and it honestly sounds kind of terrifying.
It does sound weird at first.
Like, if a stock closes at $100 and it pays a $2 dividend, you're saying it automatically opens the next morning at $98.
Yeah.
It just drops by the exact amount of the dividend.
It does. The exchange physically adjusts the opening price down by the dividend amount.
But why would anyone want that?
Well,
I mean, if my stock instantly loses 2% of its value, I haven't actually made any money. The value just moved from my stock portfolio to my cash balance.
you hit the nail on the head. The value just moved.
Really?
Yeah, think about it from the perspective of the company's balance sheet. If a business decides to hand out $2 in cash for every single share in existence, that cash is physically draining out of the company's corporate bank accounts.
Oh, I see.
So the business as a whole is quite literally worth $2 less per share than it was the night before. This is just a normal mechanical accounting adjustment.
Okay, so it's not investors panicking.
No, not at all. It is not a sign that the stock is fundamentally in trouble.
It's just a transfer of value. The cash moved from their corporate pocket to your personal pocket.
Exactly.
So getting the cash in hand makes sense, but how do you know the company isn't going to just stop paying you next month? Like, if we stick with the rental property idea, a massive rent check is totally useless if the tenant gets fired and stops skizzing on day 2.
Right. You need to run a structural inspection on the business. You can't just look at the raw dollar amount of the dividend. You have to evaluate the safety of the cash flow.
Right.
So the Capital Guide details 4 essential metrics to X-ray a stock. The first is the most universally referenced, the dividend yield.
Which is just a simple percentage, right?
Correct. It's the annual dividend paid divided by the current share price. So if a $50 stock pays $2 a year in dividends, 2 divided by 50 gives you a 4% yield.
Okay, that makes it easy to compare 2 different companies or compare a stock against a savings account.
Exactly.
But wait, so if I'm looking at a basic stock screener online and I see some random company paying a massive 15% yield, I shouldn't just hit buy. Like, is it a trap?
This raises an important question, and falling for that trap is arguably the single most common mistake beginners make.
Oh, wow.
Yeah, we call it a yield trap. Let's revisit the math. Yield is the dividend amount divided by the share price.
Right.
In any fraction, if the bottom number, the denominator, which is the share price, crashes, the overall percentage mathematically skyrockets.
Ah, I see. So if a stock was trading at $100 and paying a $5 dividend, that's a 5% yield.
Yes.
But if some terrible news comes out and the stock price collapses to $25,
Suddenly, that same $5 dividend represents a 20% yield based on the new collapsed stock price.
wow.
Yeah. When a yield suddenly jumps way above its historical average, it is almost always a massive red flag.
Because the company didn't become suddenly generous.
Exactly. The stock price cratered because the broader market lost faith in the company's ability to survive. They're likely bleeding cash, and a massive cut to that dividend is usually right around the corner.
So chasing the highest percentage is just a recipe for disaster.
Total disaster.
You need a safety check. Which brings us to the second metric in the guide, which is the payout ratio.
Yes. The payout ratio shows you exactly how much of a company's total profit is being eaten up by the dividend.
Okay.
You calculate it by dividing the annual dividend by the company's earnings per share. So if a company earns $10 per share in profit and pays out $4 as a dividend, their payout ratio is 40%.
And Capley suggests that anything under 60% is generally considered a safe zone for a standard company, right?
Generally, yes.
Because it leaves a 40% cushion so that if the economy hits a recession and the company's profits dip, they don't have to immediately slash the dividend to survive.
Exactly. They have wiggle room.
But the guide does carve out some major exceptions to that 60% rule.
It does. Context matters immensely here. Sectors like utilities and real estate investment trusts, or REITs, they routinely run payout ratios of 70 to 90%.
Wait, how is that safe? I mean, if a real estate company is giving away 90% of its profits, how do they handle a bad year?
It's actually a legal mandate for them.
Really?
Yeah. By law, to qualify as a REIT and avoid paying standard corporate income tax, the company is required to distribute at least 90% of its taxable income directly to shareholders.
Oh, wow.
That is the trade-off. They get a massive tax break, but they have to pass the vast majority of their cash flow out the door.
Okay, that makes sense.
So a 90% payout ratio for a REIT is normal functioning. But a 90% payout ratio for, say, a technology company, that means they are starving themselves of research and development funds.
Right. Context is everything. So that leads us to the third metric, which is the dividend growth rate, or DGR.
Because you don't just want a safe dividend today, you need a dividend that grows over time to protect your purchasing power from inflation.
Absolutely.
A company that consistently increases its payout by 5 to 10% every year is sending a massive, undeniable signal to the market about its underlying financial health.
They're confident in their future earnings,
Exactly.
which feeds perfectly into the final and perhaps most psychologically rewarding metric.
Yield on cost.
Yield on cost is great. It measures your personal return on investment. It calculates your yield based on the original price you paid for the stock years ago, not what it's trading at today.
Okay, let's run the numbers on that to make it concrete.
Sure. Let's say you buy a stock at $50 and it pays a $2 dividend. Your starting yield is 4%.
Okay.
But you hold that stock for a decade. The company is fantastic, so the stock price climbs to $150.
But crucially, because of that dividend growth rate we just mentioned, they have also steadily increased the cash payout. So now they pay $5 a year in dividends.
So $5 divided by my original $50 purchase price, that's a 10% yield on my money.
Exactly. A
Yeah.
brand new investor buying the stock today at $150 might only be getting a 3% yield.
Right.
But your personal yield on your original capital is 10%. You are locking in higher and higher returns simply by holding on to a quality asset.
That's incredible. But, running this mathematical diagnostic on every single stock sounds pretty exhausting for a beginner.
It can be a lot.
Finding companies with safe payout ratios and decades of dividend growth requires some heavy lifting. So aren't there companies that have already proven they can survive anything the market throws at them?
There are, and they form the absolute royalty of the stock market. The Capital Guide highlights two elite categories: the Dividend Aristocrats and the Dividend Kings.
I love these titles. What actually earns a company that kind of status?
Well, a Dividend Aristocrat is a company in the S&P 500 that has raised its dividend payout for at least 25 consecutive years.
Wow.
Not just paid a dividend, but actively increased it every single year for a quarter century.
And a king.
A Dividend King takes it even further. They have raised their dividends for 50 or more consecutive years.
Okay, here's where it gets really interesting. 50 years of continuous dividend increases.
Yeah.
That means some of these kings were steadily raising their payouts through Nixon's resignation, the dot-com bust, the 2008 financial crisis.
A global pandemic.
Right. You can't fake that kind of track record.
You really can't. And if we connect this to the bigger picture, you have to ask yourself, what specific kind of business model survives and thrives through all of that macroeconomic chaos?
Right.
Look at the examples provided in the text.
Yeah.
Johnson & Johnson, Procter & Gamble, Coca-Cola, Walmart.
Okay, so toothpaste, medicine, toilet paper, groceries, just the boring stuff.
The essential stuff. These are intensely defensive businesses selling everyday necessities. I mean, during a severe recession, consumers will absolutely delay buying a new car or upgrading their laptop.
Oh, for sure.
But they will still buy soap, basic groceries, and headache medicine.
That's very true.
That highly predictable consumer behavior translates into predictable corporate cash flow, which allows these companies to keep rewarding shareholders no matter what the broader economy is doing.
And the guide points out this isn't just an American phenomenon either. They mention the Royal Bank of Canada, which has paid a dividend every single year since 1870.
That predates the invention of the telephone.
That is wild. Okay, so we know the mechanics of the payout, we know how to check the safety metrics, and we know the types of bulletproof companies we want.
Yep.
But staring at a list of 50 Dividend Kings is still just a list, not a strategy. So how does Capital suggest an actual beginner put these pieces together?
The guide offers 4 distinct blueprints for constructing a portfolio, starting with the lowest effort approach: dividend ETFs or exchange-traded funds.
Okay.
This is the set it and forget it model. By purchasing a single share of an ETF, like the Schwab US Dividend Equity ETF ticker SCHD, or the Vanguard Dividend Appreciation ETF ticker VIG, you get instant diversification across dozens or hundreds of quality dividend-paying stocks.
And for listeners in Europe who face regulatory restrictions on buying U.S. domiciled ETFs, Capitally points out UCITE's equivalents, like Vanguard's VHYL, that accomplish the exact same goal.
Exactly.
It's incredibly efficient because the fund managers handle all the X-ray metrics and rebalancing behind the scenes for a very small fee.
It really is the easiest way to start.
But I did notice a very stern warning in this section about chasing yield through exotic ETFs.
Yes. You must avoid the high-yield trap in the ETF space, just like you do with individual stocks. Beginners frequently see funds like the YieldMax ETFs advertising massive yields of 20% or more paid out monthly.
Which sounds amazing.
It does, but those funds don't just buy stocks. They use complex options strategies, specifically covered calls, to manufacture that income.
Okay, stop right there. Covered calls sounds like the exact kind of Wall Street jargon that scares people away from investing.
It can be intimidating.
What is that actually doing, and why is it dangerous for someone trying to build long-term wealth?
Let's use a real estate analogy.
Okay.
Imagine you own a house worth $300,000. You sell a legal contract to a buyer for $1,000 in cash today. The contract says that if your house's value jumps to $400,000 this year, you still have to sell it to them for $310,000.
Okay, so I get a guaranteed $1,000 right now. That's the high yield. But I just signed away my right to make a massive profit if the neighborhood suddenly becomes highly desirable.
You perfectly summarized the danger. You pocketed the upfront premium, but you completely capped your upside potential.
Ouch.
Yeah. In a roaring bull market, the underlying stocks in those ETFs might skyrocket, but the ETF's value stays flat because they sold away all the growth.
That makes a lot of sense.
Those products are highly specialized income tools designed for retirees who need maximum current cash flow and don't care about long-term growth. They are a terrible fit for a beginner with a multi-decade time horizon.
That is a brutal trade-off. So stick to the traditional, boring ETFs.
Yes.
Got it. Now, the second blueprint is simply buying the aristocrats and kings we just talked about. Capitally calls this the quality-first approach.
Right. You manually build a basket of 5 to 10 of these elite companies. It takes more work than an ETF, but it gives you total control over what you own.
Yeah, that makes sense.
Yeah.
Now, this third blueprint really caught my eye because it sounds almost too easy. It's called the Dogs of the Dow.
Oh, this is a classic.
The rule is, on January 1st, buy the 10 highest-yielding stocks in the Dow Jones Industrial Average. Hold them for exactly 1 year.
Right.
Next January 1st, look at the Dow again, sell the ones that dropped out of the top 10, buy the new ones, and just repeat. Wait, the Dogs of the Dow sounds almost too simple. Like a robot could do it.
It is very mechanical.
Does just buying the top 10 yields actually work without doing any deep research into the specific companies?
It sounds totally counterintuitive, especially after we just spent time warning listeners to avoid yield traps.
Right.
But the Dogs of the Dow strategy works specifically because of the strict universe of stocks it uses. The Dow Jones Industrial Average is comprised of 30 massive, highly established blue-chip companies. They are the titans of industry.
Okay, so they aren't some obscure penny stock teetering on the edge of bankruptcy.
Exactly. So if one of those 30 titans suddenly has an unusually high yield, it's almost always because its stock price has been temporarily beaten down by short-term bad news, maybe a poor earnings quarter or a broad market sell-off.
Ah, I get it.
The mechanical rule of buying the highest yields naturally forces you to buy these blue chips when they are on sale, and then you ride them back up as they revert to their historical average. It completely removes human emotion from the equation.
It's an automated contrarian strategy. I actually really like that.
It's very...
So the fourth and final blueprint is the sector-balanced approach. Capitally describes this as a balanced diet. You intentionally spread your investments across 5 distinct economic sectors, like utilities, consumer staples, healthcare, financials, and tech.
The core logic here is that different sectors react in wildly different ways to macroeconomic conditions.
Yeah. Okay, like how?
Well, if inflation spikes and interest rates rise, utilities and real estate often suffer because their debt becomes more expensive.
Right.
But financials like banks often thrive in that exact same environment because they can charge more for loans.
That makes perfect sense.
By ensuring your capital isn't overly concentrated in just one area, your income stream remains stable even if an entire sector of the economy experiences a terrible year.
So we have our blueprint, we are diversified across sectors, we are avoiding the yield traps, and those quarterly payments are finally starting to roll in.
Yep.
But let's be honest, getting 26 cents a share from Apple isn't going to let me retire on a beach anytime soon.
Probably not.
How do we take this strategy from generating a nice little bonus, maybe a free dinner once a quarter, to building actual life-changing wealth over time?
The guide is unequivocal on this point. You have to let the dividends do the heavy lifting for you through a mechanism called the DRIPE.
The DRIPE.
That stands for Dividend Reinvestment Plan.
Okay, walk us through how a DRIPE actually functions in a standard brokerage account.
A DRP is an automated setting you enable with your broker. When a dividend payment hits your account on that payment date we discussed earlier, the broker doesn't just leave it as cash.
Okay.
They automatically turn around and use that exact cash amount to buy more shares of the stock that just paid you. They do this instantly, usually without any trading commissions, and they will even buy fractional shares if your dividend isn't enough to buy a whole share.
So what does this all mean? It means your money is making money, and then that new money is instantly put to work making more money, which buys even more shares, which generate even more dividends.
It is the purest definition of compound interest.
An avalanche of cash flow.
Exactly. The Capital E Guide provides a staggering mathematical example to illustrate this. Imagine investing $10,000 into a stock yielding 4%, and you leave it there for 30 years.
Okay, 30 years.
If you decide to take the cash dividends every quarter and spend them, you are earning simple interest. Your total portfolio value at the end of 3 decades is roughly $22,000.
I mean, turning 10 grand into 22 grand isn't terrible, but it's not exactly a rocket ship.
No, it's not. But now, run the exact same scenario and turn on the DRP.
Yeah.
By automatically reinvesting those dividends to acquire more shares over 30 years, compounding takes over. That same $10,000 investment grows to roughly $32,400.
Wow. Wait, really? That is a massive difference.
It is a 47% difference in your final total wealth, achieved entirely by checking a single box in your brokerage settings that says reinvest.
That is just wild. But the guide includes a very practical mechanical warning about this, depending on where you live, doesn't it?
Yes, it does. For investors in the United States, dividends generally do not reinvest themselves by default.
Oh, really?
Yeah. If you do nothing, the cash just drops into your account and sits there idly, earning zero return. You must proactively go into your account settings and enable the DRIP.
So you have to actually turn it on.
Yes. Conversely, European investors often have access to what are known as accumulating ETFs.
Okay, how do those work?
These funds automatically reinvest the dividends internally before they are ever distributed.
Well, that's convenient.
Very. It makes the compounding process completely hands-off and often more tax-efficient in those jurisdictions.
That's fantastic. The bottom line is, do not let your cash sit there being lazy. Force it to get a job.
Absolutely.
All right, well, we have covered a massive amount of ground today. We decoded the plumbing of the ex-dividend date and the T+1 settlement cycle. We learned how to run a structural inspection on a stock using the payout ratio to avoid yield traps. We examined the elite track records of the Dividend Aristocrats and Kings. We evaluated 4 distinct blueprints for building a portfolio. And finally, we unleashed the sheer compounding power of the DRIP.
It is an incredibly powerful, historically proven strategy for building wealth and securing a predictable income stream. But, as we wrap up, I think it is vital to leave you with a thought rooted directly in the frequently asked questions section of the Capital E Guide.
Okay, let's hear it.
We've spent this entire deep dive extolling the virtues of companies that pay out their profits as cash. Yet, it is an undeniable fact that some of the most phenomenally successful companies in modern history, companies like Amazon, Google, and Berkshire Hathaway, famously refused to pay a dividend for decades.
That's a really great point. I mean, Warren Buffett is famous for loving dividend-paying stocks, but his own company has never paid one.
Exactly. Those companies made a calculated bet. They believed that by keeping every single dollar of profit and reinvesting it internally, building new warehouses, funding radical new technologies, or acquiring competitors,
right? Expanding the business.
Yes, they believed they could create vastly more long-term value for their shareholders than they could by handing that cash out as a dividend. And mathematically, they were right. They engineered some of the greatest capital appreciation the market has ever seen.
Which brings us perfectly back to where we started our conversation today. The choice between the rental property and the rare comic book.
Exactly.
As you sit down to structure your own investing journey, you have to ask yourself a fundamental question about your own psychology and your financial goals.
Yep.
Do you want the steady, sleep-at-night reassurance of a dividend king paying you rent through economic booms and busts? Or are you willing to forego that tangible cash in hand to bet on the capital appreciation of the next great growth engine?
Or perhaps you build a portfolio that embraces a little bit of both.
Right. It is definitely something crucial to ponder as you start putting your capital to work. Thank you for joining us on this deep dive.